Good morning, bonjour, good afternoon, wherever you may be. Thanks for tuning into this virtual Reuters Newsmaker. It's the first one that I've done, so bear with me. I'm Rob Cox, the global editor of Reuters Breaking Views, and like all of you, I'm coming to you from my home in Zurich, Switzerland. I'm joined by my colleague in Palo Alto, Gina Chong. Hello, Gina.
Hi, everyone.
How are you?
Great, holding up.
Good. We have a fantastic panel here to discuss, the implications of the coronavirus on the global economy, markets, and beyond. These are people that Gina and I have known and spoken to during economic boom years, normal times, and more difficult circumstances like the global financial crisis, but none of that can compare to where we find the world economy today. So let me introduce them. Joining us from Paris is Laurence Boone. Laurence is the chief economist of the OECD. How are you? How is your lockdown in Paris, Laurence?
So the lockdown in Paris is fine. It's a bit strange to see a very bright blue sky, lots of sun, and absolutely nobody in the street.
Well, it would be nice if it weren't for these reasons. It'd be a lovely time to stroll along the Seine, I'm sure. But yeah. Oh, so from Connecticut, we have Jason Furman, professor of the practice of economic policy at Harvard Kennedy School and former chairman of Council of Economic Advisors under President Obama. Jason, how is my native nutmeg state?
It's also, I'm seeing a blue sky outside. I'm not seeing a lot of people. And, my children are currently homeschooling themselves. At least I hope so. Otherwise, you might see them.
Good. Lastly, from Florida, we have Kevin Warsh. Kevin is the former governor of the Federal Reserve Board, who's now visiting fellow in economics at Stanford's Hoover Institution. Kevin, how is sunny Florida? I assume it's sunny, because why wouldn't it be?
It's indeed sunny. Much like you heard reports from elsewhere, there's no one on the streets, and the governor has put us in shelter in place. So for most of us on this video call, we can still do our work, however inefficiently. The same can't be said for most Americans who aren't able to do their work as remotely as we.
Yeah, no, it's very tough. Well, look, it's great to have all of you here. I know you're incredibly busy teaching classes, writing reports, consulting, and catching up on episodes of Tiger King on Netflix. But so without further ado, I want to pass the first question to you, to Gina in Palo Alto.
Thanks, Rob. So I guess we wanted to start off with a broad question just about how you're seeing the world, given the devastating speed with which we've seen the outbreak and its effects on public health and the global economy. In the United States, we got some pretty bad news today in terms of the weekly jobless claims hitting another record at 6.6 million. So Jason, I wanted to start off with you just in terms of your assessment of the economic damage so far and how bad do you think it could get? And we'll go down to the others as well. But Jason, if we could start off with you.
Yeah. I mean, the economic damage in the short run is massive. It was done on purpose by the government and done, in my view, for very good reason in order to control the spread of the virus, which needs to be done in order to ever have an economy in the future. We knew the extent of it, but that doesn't, no matter how much you know, when you see a number like 6.6 million people filing for unemployment insurance, you're not prepared for something like that. The bigger question, which we don't know yet, is this like a natural disaster and the economy springs back, or is it like a financial crisis and it takes a very prolonged period to get back? So right now, there's no ambiguity. A year or two from now, I'm on the pessimistic side, but that's the big question: is can you restart the economy? Not did the economy stop? We all can look outside and see that. We don't need the data.
Yeah. And Kevin, how about you from your perspective, especially because you had been at the Fed during the crisis and have seen a lot of bad times yourself. How do you see the situation now?
So I think Jason captured the moment pretty well. I mean, we've spent most of our careers thinking and seeing both firsthand in government and on the outside what happens when governments put economies in recession, but that's usually by accident. This, as Jason says, is by choice. And so by that very means, it's a different kind of recession. It looks as though that the government's attempts to shut down the U.S. economy have been very successful, maybe more successful than some would have thought. Something like half of consumer spending by the time we get to end of this week will be gone. And that's just, that makes it the biggest shock that we've seen in 100 years.
And Laurence, how about you from your perspective in Europe in particular, where we've seen the economies of Italy and Spain and others really take a toll because of this?
So you're right, and it's pretty similar to what both Kevin and Jason have said. I think so. Now in Europe, most countries have been in lockdown for between 3 weeks to 1 month, and even like 5 weeks for Italy. The initial shock to the economy of the lockdown, we've estimated that the OECD is between 25 to 35% on the level of GDP. And obviously the impact will be the tougher, the longer confinement lasts for. The conversation is a little different on 2 accounts. I think the first one is most European economies have put in place huge buffer on top of the very large automatic stabilizer. So they all have what's called short-time working schemes. So people stay employed and the government contributes to their wage to a large extent. So we don't observe as much of a shoot in the unemployment figures as what we see for the US, but it's very costly, obviously. And the second thing on which it's a little different, because confinement has been going on for a while. Now the discussion is moving towards how do we get out of there? And how do we get out of there knowing that infection rates have been kept low by confinement? So there's no what we call herd immunity. For example, infection rates in Europe vary between 0.7 in Germany and up to 15% in Spain. But that's the discussion we start having.
Okay, that's a pretty grim scene setter. Rob, next question for you.
Sure. I mean, all of you have written op-eds and various pieces and blogs and on what kind of response is required to deal with this unprecedented economic disruption. Are you mostly encouraged by what the monetary policy responses that we've seen, whether it's from the Federal Reserve or the ECB or the Bank of England and other central banks? And then it's the first question, I suppose. But then the second to that is, have we had the right fiscal response as well? We saw the $2.2 trillion stimulus in the United States. We've seen various European governments come up with different schemes. So I'd just love to get your perspectives on what's been done and whether you're encouraged by what's been done or you think there's more that needs to be done, and maybe specifically you have some thoughts on that. I'll start with you, Kevin, because I know you wrote something that was quite interesting about how we could fund small businesses, for instance, through the Fed. Are you happy with where we are with the response?
Right. So I'd say, judging by the speed of action by the U.S. Central Bank, the speed's been quite remarkable. They've moved faster than we moved more than a decade ago. First, using the facilities that we had designed and put in place, and then quickly, I think, realizing that the nature of this crisis was fundamentally different than the nature of our crisis in 2008. So they've been rolling out products and facilities, including one that I'd written about a few weeks ago, which hasn't been fully rolled out, which they're calling a Main Street credit facility. And the idea is pretty simple. We need to buy time to see what the future is of the virus and of the economy. The best way to do that in central banking is to roll out liquidity to all solvent comers, to all businesses that were in reasonably good shape before the crisis, so that they can buy time before shutting down or doing things that are too radical We haven't seen the details of the Fed's program, but I'm hopeful we'll see it over the course of this week. And among the things that Congress did that I thought was most productive was really providing the backstop funding that will go through Treasury that should allow the Federal Reserve to be a backstop. So in the event that there are any losses from these new liquidity lines, the fiscal authorities would pay for it, which is really inside their remit, not inside ours. So that's an encouraging note. I'd say on a somewhat surprising note from where I sit, the world central banks have all moved interest rates effectively to zero. They've all gone back to their QE programs, but they've done that in a way which is correlated but not coordinated. I do tend to think that they would get more bang for their buck if they so could on Sunday nights taking these actions together. And one more piece I would add before turning it over to my colleagues here. The nature of this crisis, Rob, is that this is the first crisis where the first war we've had where the enemy can't read. So I think the war plan should be put out there for everyone to see. Economic war plan should be described broadly. What are the goalposts? What are we trying to do? What are we not trying to do? And so I think it's time that the big policymakers emerge from what had been a brutal bunker scenario where they've acted with speed and I think some efficacy and tell their story of what they see happening. Obviously, there's tons of uncertainties, but I think citizens and businesses could use clarity even if they can't get certainty from them at this point.
Laurence, maybe you can give a perspective on what's happening, particularly in Europe, and also maybe address a little bit Kevin's point about coordination. One feature of the 2008 crisis certainly was, we saw incredible cooperation between central banks and fiscal authorities. It does feel a little bit like everybody's jumping out on doing their own thing. I'm just curious where you stand on that.
So I largely agree with Kevin that there has been an amazing policy response both on the monetary and the fiscal front. I think, policymakers have really leveraged on what they have learned from the financial crisis to be able to provide very forceful answers. They've also gone beyond what they had done in this episode, whether the Fed with its unlimited QE or the scheme that Kevin was describing. But there's also huge extension of swap lines, which are the best expression of coordination. I agree that apart from those lack of coordination on many fronts, one is obviously on managing the healthcare crisis. If anything, there's competition for healthcare material, which is not a good idea. But on the monetary side, we have seen individual action. One of the reasons being the peculiar architecture that exists in the Eurozone, where the central bank is not backed by one treasury, but by many treasuries. But to a large extent, I would say that they're leveraging on each other recipe and really acting forcefully. I think one of the reasons why financial markets have actually taken time to react and are still very unsettled is because there's so much uncertainty with the evolution of the virus and the way it is being addressed and how long it's going to last for. And I think that's where coordination should really focus for that and for taking care of all that's happening outside of the G20, where things are really bad.
Right. And Jason, you had an op-ed where you made the case for a big coronavirus stimulus. Have you been satisfied with what you've seen? I mean, you wrote that about a month ago.
I'm incredibly impressed by the speed of what's happened in the United States, the scale of what's happened in the United States, and similar responses around the world. But the speed and scale of the assault on the economy may be even larger than what we've seen from policymakers. Just to put the US response in context, I did the first meeting with Congress on what became the Recovery Act on December 17th, 2008, right after President-elect Obama had decided what he wanted to see in it. 2 months later, he signed it into law, and it was about $800 billion. That was during a financial crisis, and that was an all democratic government, which is easier to get things done. This is divided government at a time of enormous acrimony and polarization. In 8 days, did something about twice as large as what we did a decade ago. And I think a lot of ideological preconceptions were set aside. You know, there were some Republicans out there saying we need supply side tax cuts, but the vast majority understood the problem right now isn't giving people an incentive to work, it's having people survive. There were some Democrats out there who thought this was a great opportunity to expand unionization and change election laws and do whatever else. And you can argue for or against the merits of those ideas, but they have nothing to do with preventing an economic calamity over the coming months, and those ideas were set aside as well. So I think there has been, so far, a greater degree of pragmatism, leaving your ideology aside, a greater degree of speed and scale than what I would have expected. Round 4 in the United States is looking, right now a little bit more ideological. Speaker Pelosi is talking about passing something. Senator McConnell, the Republican leader of the Senate, is saying don't pass it. There's a lot of discussion of infrastructure, which I think is a perfectly wonderful thing to do, as long as it doesn't crowd out the things that are incredibly more urgent and more important than it, like continued assistance to low-income households, preventing state budget cutbacks from undermining some of what the federal government has done, and then extending and expanding a lot of what was done, which was designed more for a 2-month lockdown, not what at the very least will be 2 years of economic rebuilding that will be needed. So, the last thing I'd say is, at least for the United States, where we have divided government, the initial response is usually a little bit easier. You understand you've been attacked. You can bring people together. There's this we're in it together type of sense. But then as the problems start to mount, people will look, that person got something unfair. That business gave a raise to its CEO. I'm here hurting. And the resentments start to build. And that's what I'm worried about. That's one of the reasons I've been encouraging as much as possible that legislation should have triggers in it. Such and such lasts and continues to happen until the unemployment rate falls below a certain threshold, until the health emergency is over, and some landmarks that you set out in advance rather than trusting Congress to every 2 months pass some new law.
Right. Interesting. Well, go ahead. I'm going to go to you, Gina.
Oh, sorry, Lawrence, did you want to?
Yeah, if I can just jump in. So
Go on.
At the OECD, we're tracking all the measures that OECD member states. So that's about the, roughly 40th richest country in the world all these countries have put in place since the beginning of the crisis. And I would really enhance what Jason has been saying. It's absolutely amazing, the speed and the magnitude of what countries have been doing. They have been firing on all their tools. They're supporting people losing their jobs. They're keeping people in jobs by paying them. They're providing tax deferral charges, deferrals, or tax cuts for all sectors affected. They're postponing tax payment, mortgage payment. They've been asking banks, Kevin was talking about the Fed to Main Street. I would say in countries where banks are still big intermediates, then they've been guaranteed by states to carry on providing lifelines to most firms and SMEs. So really all the policy tools that policymakers have in their hand, they've been using to a massive extent, which is extremely good if we think that the shock is going to last 2 to 3 months. And I think we should all be very impressed by the responses that have been put in place so far in most countries.
And Rob, can I jump in as well?
Yeah, go ahead, Kevin.
So let me just build on what Lawrence and Jason said, see whether there's a distinction or agreement here among the panelists. So I'd say three things. First, I don't particularly like the language, at least in the US, of stimulus. You know, the government chose to shut down the economy with one hand. It strikes me as strange if the government's then trying to goose spending with the other hand. The language, I think, is more right and more consistent with what this bill was about that the president signed is income support. This is a rich and generous nation, so the motivation was to try to provide some help to those that can't work remotely, that have been sort of put in harm's way through no fault of their own. And I think the ideological fights, supply side, demand side fights, will be back when we're talking truly about stimulus, how to get the economy going. So it's a distinction, but I think it's a distinction with a reasonably big difference. My sense is that the way the US economy works is there's a complicated supply chain and also a complicated demand chain. Part of the reason why I think this shock won't just be over in a few months, even if the epidemic has peaked, is you've done more than throw sand in the gears of that, and just replacing aggregate demand through government spending with the shortfall in demand strikes me as unlikely to be that positive. So that's one. Two, I would say, while there does seem to be some comity in the fiscal support, and the parties in the US seem to be agreeing, in some sense, what they've done is they've passed many of the hard decisions to the Treasury Department, to the Federal Reserve. And I would imagine there's a long list of special interests knocking on the doors of each of them saying, please put me in that facility, let my paper be funded. So the fight is happening, it's just happening behind the curtain. And so we don't know how these policies will be executed. We don't know whether we'll be in the business of picking winners and losers, something which these other agencies, I think, are poorly situated to make those judgments about. And maybe a third point, just for my colleagues here to comment, if the economic policymakers in the US, like their peers around the world, could come out and through prepared text explain their diagnosis, the duration of what this mess is, what their tools are and why they'll work, then I think they'd get a big benefit of signaling. So you don't normally have to wait in crises for products to be launched in order to see whether they're working. You want a signaling effect to tell businesses and households where they might get some support and get markets to start working, to front run the facilities. And again, I think the next week should be filled with more messaging and signaling about those fundamental questions.
Well, Jay Powell went on the Today program on NBC. I think it's the first time that we've seen the Federal Reserve Chairman go on network television like that. You almost took that job, Kevin? Would you be on NBC or the Today Show, or how would you communicate that?
Well, on days like this, I'm quite fortunate to be sitting comfortably with you guys in the back benches and not on the front lines. I'd say there's absolutely nothing wrong with communicating the American people. The economic leaders of our country need to do that. But that shouldn't be at the expense of communicating to businesses large and small, households large and small that are making big decisions about payroll and rent and the rest. So I would say it's okay to have that broad discussion, but there's a big gap between a fact sheet on a Sunday night and the Today Show. And I think that I'd be surprised, let me put it this way, if over the coming days, we don't see the economic officials telling their economic war plan, much the same way in the US we've heard in the last couple of weeks from the healthcare officials. Some people don't like what they're saying, but it's highly informative and lets people understand, at least with clarity, what the next several weeks, months, and quarters will look like.
Jason, how do we avoid a special interest sort of taking advantage of this, or only those who have the right advisors, the right financial advisors, people who can help them to benefit from whether it's the Treasury or the Fed's programs? I mean, is it because what we don't want to have is another situation where you have a backlash to the bailouts, as it were, and we have a political crisis that in some ways follows the financial one.
Yeah, I'm worried about that backlash that you saw the Tea Party last time. I hope a tiny bit, people understand the industries that are being affected right now didn't cause this crisis. Maybe that will alleviate a little bit. But as an economic matter, I'm very worried about over-designing programs. I saw during the financial crisis, we in our administration, and you saw some of this in the Bush administration too, would put in place a housing program that was exquisitely designed to minimize moral hazard, minimize 8 other different concerns that people had, and would have a take-up rate that was a fraction of what was expected and what was needed. I think that the oversight of TARP by a special investigator general that had a massive staff of people was probably inhibiting to banks taking on capital, making loans and the like. And so, I don't know how you explain this to people, but just even understanding that the $500 billion for big business is not a grant program. It is a loan. A lot of that loan will be repaid. I don't expect all of it to be repaid. And by the way, if all of it gets repaid, that probably is a sign that the Fed over-designed those programs and it left some social good on the table. But the fact that people still look back at TARP as a $700 billion gift to banks when it was an investment that repaid itself both directly in fiscal terms and in terms of the economy is, to me, I think one of the biggest failures of any of us to explain. And that's a failure that we're living with now, because if we put too many restrictions on buybacks and pay, and the most important one is payroll. I'd love to see no layoffs. There are industries that airplanes are, air travel is just not going to see as much air travel until there's a vaccine. There's probably going to be a lot less air travel until there's a vaccine. There's probably going to be less air travel after a vaccine. They're going to need to make certain types of adjustments, and we need to facilitate those adjustments. So getting that balance between getting the politics right, but also getting the economics right. And the economics, I think right now says, let's err on the side of more and faster, not design everything so perfectly that you end up leaving out all sorts of businesses that really needed liquidity.
Gina, over to you.
Thanks. I wanted to follow up on some of the things mentioned here with Laurence. We were talking about the speed at which governments and central banks have responded, but there's still obviously some stress in the system just because we don't have a vaccine yet. And at least here in the United States, the worst of the outbreak and expected cases really has yet to come in most states. Where do you see the holes in policy, whether it's on a monetary or fiscal level, in terms of what you think could still be done to ease plumbing in financial markets, or to provide more liquidity or fiscal support to individuals, particularly the ones who are being the hardest hit by this?
So you're right that in spite of the size and magnitude, there is and there will be some hole. And I agree on 2 accounts. One with Kevin for implementation and efficacy of execution. And there's also, you will hear a lot of stories about how complicated administrative processes may be for firms who are still sponsoring jobs, keeping people on and waiting for the governments to help them pay people. But also, I think I totally agree with Jason that it's better to spread too much than too little at this juncture. I can think about two things. The first one is small and medium-sized firms. It's always difficult for them to be well targeted. And I think that's one of the strengths of going through the banking sector, is they know the firms. And if states can guarantee some of the loans or the debt that these small and medium-sized firms have, if banks can actually provide the cash that they need to pay for their rent or mortgages or other fixed costs, then that will support them going through. Then you have huge categories of people, whether it's because they're on the informal job market, they don't have proper job, or because they're living with tips, for example, in restaurants, or they had just started a job and were in probatory period, or they're on fixed term contract. So for those people, additional targeted support, like in the form of a check, so some form of helicopter money in a way, would be very helpful. And then a third and last point is we have very much focused on advanced economies, but low income countries, emerging markets in Asia, Latin America, or Middle East and Africa, they don't at all have the same institutional structure for economic policies, and it's even worse for health policy. You were mentioning coordination at the beginning of our talk, and I think there's a huge effort which is in the making to go there. And perhaps Kevin and Jason will have more to say about this, but there's a real issue about the size and the capacity of acting fast of the global financial safety net that we should also be, I think, discussing and addressing.
Great. And Kevin, for you, especially from the Fed's perspective, I feel like every day they're announcing, something new. Just yesterday, they talked about, easing off for banks in terms of the supplementary leverage ratio to deal with treasuries. Where do you see any gaps that still might need to be filled, or stress in the system that their actions so far has not addressed? And if it's even possible to address them fully, just given the unprecedented circumstance and that this is due to a public health issue as opposed to a financial issue.
Right. So I think they've been remarkably effective plumbers over the course of the last couple of weeks, and I mean that with the greatest admiration. Different parts of the market have broken down. Even the treasury market, the most important risk-free asset market in the world, has been gapping out, and even with overwhelming purchases on a scale and magnitude that we didn't comprehend in 2008 or 9, we're still seeing gaps in market functioning. So one way to deal with that as the Fed is to see a new group of assets that aren't covered by an existing program and say, okay, how do we cover that? But I think the discussion likely at Treasury and at the Fed has a bunch of owners of a bunch of so-called orphaned assets that don't qualify for any of these Fed programs that say, me too, include me in the program. And again, the Fed's gonna have to decide whether or not they just keep expanding further the perimeter of acceptable collateral, move down the risk curve, or whether what they should be doing is describing in a broader sense what their objectives are and try to signal to markets to crowd in private capital to these various things. So at some point, I think you have to move from being a strong and effective plumber, which is the important job for the Fed, to being the general contractor and start to tell your owners really what's the state of the foundation. And I think many of us on this video call have been a little bit anxious to call the duration of this virus. I guess my instinct is that this thing is going to be longer in duration than many of us would hope, and is likely to lead to scarring across the economy and markets. So the Fed is in this for the long haul with these other central banks. So the role of general contractor becomes that much more important.
And Jason, what do you feel like is missing, if anything, on the fiscal front? I mean, you had talked about in your op-ed this idea of direct payments, which they have gone to, but it's even Treasury Secretary Steven Mnuchin said this is maybe going to last for 10 weeks, if that, and Congress may have to come back, as they're already discussing, on another plan. Is that really the ideal situation for a divided government to keep coming back and having to fill the coffers, if you will? And do you think there's a better way?
Yeah, I think the biggest absence in the legislation was general fiscal support for states and localities. And just stepping back, understanding what's happening, there is an intense liquidity crunch across everything. households are feeling it, small businesses are feeling it, large businesses are feeling it, and states and localities are feeling it as well. And the entities that can best borrow at this point in time are national governments, and they're effectively borrowing on behalf of subnational governments. This legislation in the United States did include money for states to fight the COVID emergency itself. It wasn't close to enough money for states like New York, which are particularly affected, because when we do things in the United States, we want to make sure all 50 states get something, regardless of their population, regardless of how affected they are. But importantly, states are going to lose several $100 billion of tax revenue this year. They don't just have to fight COVID, they have to pay teachers to teach students starting in September. They have to have police officers. They need to have parks. They need the machinery of government to operate. And you see states around the government around the country preparing budgets now with 20% budget cuts. That would hurt the economy. Right now, I agree with Kevin, fiscal stimulus probably isn't the right word. But if you have states cutting their spending a year from now, that will chill the economic recovery. It'll hurt education and the like. So I think more unconditional assistance for states, to me, is the number one top priority.
Okay.
Second is we're just going to need to extend what we've done. Longer unemployment insurance, more checks. If the small business program does work, that funds their payroll through banks, then that will potentially need more money. I hope the $500 billion is enough for the Fed to use. But if this starts to turn into a banking crisis, and it's not anywhere close to that right now, but if it ever starts to, they'll probably need more resources for that as well.
Okay. Rob, over to you.
Yeah, I guess I think that's right. We have this duty of making sure that people, particularly the ones that Kevin mentioned, who are less fortunate than we are in the sort of information economy, can work from our various homes. There is, though, that at some point we're going to have to pay for all this. I'm just, it would be worth maybe trying to think about how we're going to pay for this. Is this going to just be higher taxes? Is it going to be we're no longer going to have a concern about debt to GDP of 100%, but 200% is the new 100%. How is this all going to play out? Or are we just going to monetize it all and it won't matter? I'd love to get your views on, maybe it's premature because we have a real crisis in our hands, but at some point we're going to have to pay the piper. How do we do that? Kevin, I'll start with you.
Sure. So I think the first thing we do is treat the state of where we are as a liquidity shock, try to overwhelm the system with liquidity to avoid a solvency crisis. And that's true of businesses, households, governments, etc. If this goes on for a long time, then in spite of our collective best efforts, the solvency crisis will be among us. I don't think it requires too much of an imagination in the US to say that in calendar year 2020, the deficit could be running something on the order of $4 trillion. So the question of how to fund it is going to become apparent. And at certain brief moments in financial markets in the last several weeks, it seems as though for an hour or two, markets have had a bit of indigestion. The Fed's had to step in to try to keep the Treasury markets not just clearing, but clearing at yields they think are appropriate. History tells us when we get confronted by a shock like this, especially if it goes long in duration, that big central governments do one of three things. They try to inflate their way out of it, devalue their currencies, or financial repression. And I would say if the virus has done anything, it's likely to have accelerated some of the rather disturbing trends, both in academia and among policymakers, about some shortcuts to dealing with it, like having the central bank make these liabilities go away. I think it's dangerous, but we'd be fooling ourselves to not be concerned about the question you raise over the horizon. And even if the US, as the biggest economy in the world, the one with the deepest capital markets, doesn't internalize the cost of this increase in funding, this massive increase of Treasury supply, I think in the next couple of years, we're likely to see these hard questions having to be resolved one way or another in some of the major economies around the world. So folks like Lawrence and Jason and me, these are issues that we've got to start tackling with now, and frankly, batting down some bad ideas that have been lingering on the fringes for the last couple of years and might find their way into the mainstream.
Laurence, when I think of Europe, I mean, it is not one borrower, right? And we have this debate that's raging right now in Europe about Corona bonds in particular, which would be the idea that you would have mutualization of debt, and so the Eurozone could potentially issue bonds that would then be used to help deal with the crisis across the Eurozone. Huge argument around this. How do you see that playing out? And then just specifically, when we think about how to pay for it, how do you think longer term we pay the piper?
So first in the short term, and I agree with what Kevin was saying, first in the short run, the European Central Bank has given space and time for Eurozone governments to actually start thinking hard about it, and that's good. You know, there is this new pandemic program that the ECB has launched, which is really giving some breathing space in terms of time and also in terms of allocation of the purchase across the country, which, as you know, is always a bit contentious. Now, as you know as well, there's a lot of discussion, and not always nice, between European member states, European Monetary Union member states, about mutualization of debt. And I think there's a lot of I think we should distinguish two things. One is, do you want to mutualize the spendings that will go with the coronavirus, which, you know, is something that no country begged for and nobody is responsible for, and for which there is complete symmetry in the way that it's, well, not complete, but there is more symmetry in the way it's addressing these economies? Or do you want to mutualize all that? So I think for the time being, we're going to put aside the question of legacy debt, the one before the coronavirus. Looking ahead, if you think about the size of the deficits that are being put on the table, say between roughly 4 and 5% of GDP, if you add to this the tax deferral and the credit guarantee, and it's on average around 15% of GDP in Europe, then you really see that the increase in sovereign issuance is going to be massive. So I don't think one tool will be enough. Financial market will be in a difficult position to absorb all this. So we will have to look at, you know, perhaps doing something like what the Bank of Japan is doing with yield curve control and purchasing some of the debt, at least for a quite significant period of time. We will have to think about these bonds that finance the corona-related spending, if they're supranational. One of the reasons why governments look at it is that in that case, it doesn't add to national debt. And there are obviously some countries which wouldn't like to see their national debt increase too much. And then I think there will be, but perhaps more medium term, a lot of thinking about how you tax the economy, how you spend in the economy, but that will definitely come later. But if you remember, and I'm sure Jason and Kevin have a lot to say about this, there was a lot of debate prior to this crisis about wealth taxation, income taxation, and given the people who are bearing the blunt really of the crisis are probably the lower skilled, lower income one. I think this debate will come on the table. So sorry for the digression, but I think it's, yes, part of this debt financing will come from central banks. We shouldn't fool ourselves. Part of this may come in Europe from mutual bond issuance, but that's also debt, and at some stage, you know, what's handy is the central bank can also buy it. Part of it may be inflation, but the last chunk will be taxation, and we will need to think hard how to make that good. Jason,
what's your perspective on how we pay for this in the end?
Yeah, I mean, when the United States fought World War II, it ran a deficit one year of 30% of GDP, 3 other years about 20% of GDP. You saw the debt jump from 40% of GDP to 100% of GDP. I don't think this will be anywhere close to that, but there is the capacity there when you're attacked to respond. And in the short run, there's a set of things you can do to handle that debt, including, Laurent said yield curve control. I would frame it that way, but that's effectively partially monetizing your debt. That's not what you can do over the longer term. And so I would add a fourth to Kevin's list of things. In 1946, the debt was 106% of GDP. By 1974, it was 23% of GDP. That happened despite running deficits most of the years over that period because the growth rate exceeded the interest rate. Now, right now, we have a lot of problems and challenges with growth, but interest rates are also much lower than they were back then. This isn't automatically going to get our debt down as a share of the economy, but it's something that, if you can stabilize over the course of decades, and by the way, stabilizing at 100% of GDP, I'd be completely comfortable with that, allowing it to drift above that sum. I think there's relatively little evidence that that causes a problem, but there has to be some path that is understood. The low interest rates help on that, but they don't fully solve it. I was of the view before this crisis, and I continue to be of the view that the United States is a very tax-phobic country, and we're going to need to ask for more. I'm in favor of high income taxes. Wealth tax isn't my favorite way of doing it, but we could debate the specifics, but that won't be enough. And can you go to people and say you need to more broadly pay? I'm not sure, because I'm not sure the goodwill is going to be there for that. But at some point, additional revenue in a broad-based way is going to be needed. You won't need a huge amount of it. You don't need to run budget surpluses. You just can't have too huge a deficit 5 or 10 years from now in order to take advantage of the low interest rates and the glide path you can get yourself on.
I think it's going to be hard to envision lower taxes in after this crisis. Maybe one of you wants to debate that, but you mentioned wealth taxes, Jason. I mean, it seems to me that one of the big questions around this is that we stopped the economies around the world essentially to save, it's not entirely, but a cohort of the economy a cohort of the population that's older, more vulnerable. That raises questions around whether we're facing an intergenerational transfer, if you will, of wealth or debt from the older generation to the younger generation. Not entirely, of course. There's lots of this disease does not seem to be entirely ageist in its path. But I'm just curious whether this, something like a wealth tax actually could be designed in such a way so that you do rebalance it. You rebalance these payments in some way from those who have to those who don't yet have. No, Kevin, what do you think about taxes?
So,
are you a fan, Kevin?
So I don't like taxes, just as a first approximation. My friend Jason loves taxes. He loved taxes before the crisis. He loves taxes in the middle of the crisis, loved taxes afterward. Doesn't think it has a big effect on behavior. So we have a different view on that. Let me see if I can answer.
This is why I bounced it straight to you, Kevin.
Yeah, let me see if I can answer your question a little bit more concretely. We are rightfully dwelling on the crisis in which we find ourselves, and we're rightly calling it an emergency. In 2008 and 2009, I think we did the same thing. We rightly called it a crisis and called it an emergency. I think the challenge when historians look back, what they're going to look back to is the historic interval between the last crisis and this crisis. And they're going to ask a very uncomfortable question. Did we use the peace between the two great wars to put ourselves in a responsible position to respond to whatever shocks happen? And I must say I'm rather uncomfortable with how historians will look back at that period between the wars. We ran ourselves to the largest deficits with this low of unemployment rate at full employment. We never normalized the broad conduct of monetary policy in the US and around the world. The corporate debt situation, which I would say some of my former colleagues are now rightly describing as precarious. That didn't happen by accident, that happened as a result of government policy. So it does strike me as though there will be an appropriate time to look back on the decade between these wars and ask whether we tried to answer the one salient question: what will we do if there's a shock? And that strikes me as the most important question central bankers should ever do, should always be asking. And instead, we've treated really the last 15 years like a continuous emergency. And because of that, I think we have fewer good solutions at this moment. And the scarring from this crisis could be somewhat worse than had we sort of normalized in that period between the wars. And that's a function both of tax policy and spending policy, in addition to monetary policy.
Jason, what's your, just to elaborate a little bit more on taxes.
Kevin did reference deficits. The fact that tax revenue before this was 16% of GDP, the lowest it had been in 50 years outside of recessions, tells me that in that respect, we were less prepared than we should have been. On monetary policy, I'm much more positive on the way it was handled in this period. I don't think the Fed or the ECB or the Bank of England chose lower rates. I think lower rates were imposed on them by a dramatic change in the structure of the economy, with less businesses investing, more people saving, and just to even keep adequate economic performance, they needed to have quite low rates. Had interest rates been 6% going into this, do I think we'd be in better shape? No, we probably would have had even lower inflation than we had, even more of a risk of a deflationary spiral than we have right now. So I think monetary policy has been, the one aspect of macroeconomic policy I think has been done, reasonably well in the past, is going reasonably well right now. And of course, nothing that we're talking about is remotely as important for the economy or for society as what was done on health. And that is where we certainly failed in our preparation in a very big way.
Laurence, just thinking, going back a little bit to the tax question, you were in France when you were in the government, I believe, the Sarkozy government. Did you have a wealth tax? And you had I'm just wondering if this debate is different on the other side of the Atlantic, about how we might pay for things.
So there are two things. One is the average tax to GDP ratio in OECD countries probably closer to 35% than 16 mentioned by Jason.
Federal, I should say. Yeah, but anyway.
Okay. And France is at the top of all OECD countries in terms of tax to GDP ratio. So unlike my US colleagues, I can say that we like taxes because we like redistribution, but also because the economy doesn't work in terms of equality of opportunities. But I would like to come back on this wealth tax, and also that goes with the inheritance tax. I think there are very few countries who have them, and the debate in France, as usual, has been from one government to the other. It's a pendulum, right? Once you've got it, once it disappears. Inheritance tax, death tax are not popular anywhere. Wealth tax are not that popular either. And more than that, they usually bring little money in. So what matters most, I think, is to make the income tax system really progressive and able to finance, among other things, the huge increase in healthcare spending we'll have to finance. But I would focus the debate on wealth and death tax, which are in any case bringing very little receipt. Or they have to be really repressive.
Right. I also think we need to focus on the benefit side. I think that's where it's clearest The United States was one of the only countries in the world, joined by Papua New Guinea, not to have a paid leave program in place 6 months ago. Congress, a few weeks ago, invented a brand new paid leave program in the middle of a crisis, essentially financed by businesses on the front end and reimbursed by the government later. I'm not sure how well that's going to work. I really wish that we had had a paid leave program already in place that at least could be used as an automatic stabilizer and potentially could be expanded on. Sick leave was something that wasn't universal in the United States going into this. I think the idea that you would impose sick leave on companies in the middle of this is quite a big problem. But in normal times, and have that system in place, absolutely. So I think, and then state unemployment insurance systems that are operating by telephones rather than computers on paper and couldn't handle the volume before all of this, and now the volume has gone up 20-fold, is just another example. So I think a lot of the parts of the US social safety net that we very much knew were inadequate, this is exposing the inadequacy of it. And some of the attempts to patch it up in the middle of this, I think, will only be partially successful, which will be an argument for really getting it right over the longer term.
How much, so if I can ask Jason, the question is, how much of all these new benefits and spending do you think are going to last beyond the crisis? Like how much of this could design a larger US social safety net than what we have seen in the past?
I think, unfortunately, the ways it's been done so far are like getting a bit of chewing gum and duct tape and taping something together. And it might be the way that makes sense to do it now, but actually isn't the way to make sense doing it in the longer term. So unfortunately, from my perspective, or fortunately if you're Kevin and worried about creeping, I don't think you could take any of what's been passed now and just make it permanent. I think you need to do something pretty different for paid leave, sick leave, or unemployment insurance.
Gina, pass to you.
Yeah. So, and I know we're starting to run short on time, so I kind of wanted to ask, looking forward to everyone, and Kevin, starting off with you, just how do you see a recovery playing out, and what do you think are the longer term changes that happen in terms of whether it's on the individual level, corporate level, or government level in terms of our economic behavior? Because I feel like this is, none of us are going to come out of this the same as before. And the way we travel, where we think about where we want to live, where we want to work is all going to change. How do you see that in the long term? And then, just getting out of this in the short term?
So, Gene, I think it's a fair point. I think there's a tendency to think, well, if the apex of the virus is gone in 60 days, then we'll just go back to how things were. And with Jason's good urging of his colleagues, we'll fill aggregate demand and we'll just go back to the economy in January. I just don't think that's how it's going to work. We recall how different the landscape was, not just for banks out after the last financial crisis. And this one seems to be having a bigger imprint on society. So fundamentally, there are going to be huge changes in household consumption patterns and business patterns and global supply chains. And Jason and some colleagues have done some really good work over the last decade that has shown that even before this crisis, the companies and the countries that are at the frontier of productivity have separated themselves from the median in their sector. The best countries have separated themselves from the median of the G20. I think those trends are likely to be continued, if not accelerated, over the course of the next decade. The winners will be bigger winners. The people in the middle will be stuck with fewer alternatives. So the frontier of productivity and innovation will probably be higher, but that has huge implications for the broad society. So I'd say at the micro level, the consequences are huge. And at the macro level, just to finish off, many of the trends that we've been seeing and debating over the course of the last several years the fights between the G2, the US and China confrontations, those aren't going away. If anything, the virus looks to me to be an accelerant of those tensions. The re-regionalization, what some call deglobalization, that seems to have now been further accelerated. The push by some for wealth taxes and having the US government be a more integral part of every boardroom discussion, these trends are I think, coming closer and closer. The key to all of this is to try to define the emergency exactly as it is. And when the emergency is over this time, unlike the emergency in 2009, we shut the door, we prepare for the next emergency, and we try to go back to a style of economic growth in the US that can ensure what Jason said at the outset, the G is greater than I and forevermore. And the only way to do that is to be very confident you're putting in the right sort of policies to have high economic growth of the next generation. Because if we don't, we're going to end up perhaps in a much less strong position when the next crisis hits.
Right. And Jason, I know you've also been skeptical in terms of, especially at least in the US, us seeing a V-shaped recovery. How do you see things when they improve, and what do you see as sort of the long-term effects of how this changes all of us?
Right. So none of us have ever seen anything like this. So I don't think any of us can be confident. I think the odds of a V-shaped recovery, though, I would put them relatively low. I wouldn't be surprised if 5 years from now, we continue to have unemployment rates that are significantly elevated compared to where they were before this. I absolutely do not think aggregate demand is a panacea, but it is necessary. It's not sufficient, and it's something that we know how to do. So we should do that. We shouldn't mess that up. And last time we didn't do quite enough aggregate demand, but figuring out how to put the pieces together of businesses, of supply chains and the like, that's absolutely necessary too. There isn't quite a playbook for all of that. But figuring that out as we go along is important. Did want to highlight, though, that as worried or realistic as I am about the United States, about France, about Europe, and the like, something that Laurence briefly brought up earlier, when you look at poorer countries, when you look at emerging economies, when you look at developing economies, they're going to be very hard hit. I think we don't know anything about the magnitude of this right now because of the lack of testing in a lot of those countries. They don't have anywhere capacity that the advanced economies have. The IMF has already gotten a ton of applications. It has a lot of resources now that it didn't have in the crisis. But unlike the Fed and the ECB, it doesn't have an effectively unlimited amount of resources. And then I'm worried about the patience and interest that policymakers and the public in the rich countries will have about a financial crisis happening on the other side of the world. I think that worries me for the sake of those countries, and it worries me also for the sake of the global economy. Coordinating or correlating across the Fed and the ECB is pretty easy. They both have exactly the same situation, want to do the same thing. How you coordinate with the Reserve Bank of India is a little bit trickier given the different positions of the two economies. And we need to get this right domestically, but we're also going to need to make sure we're looking outward and protecting the global economy as well.
And Laurence, how do you see things going forward in Europe?
So it's going to be a little difficult to add to what Kevin and Jason have said, and to which I largely agree. I would mention two things. One is for the European Union. I think it's a real test. Either European Union countries have started displaying some solidarity and building up some schemes to support each other unemployment and each other spending. It has been a little slow, unlike what national policymakers have done, and I really wish that it's going to accelerate and continue on this train, because that would really help consolidate the European Union. which has been a bit shaken by Brexit and by the sovereign crisis in the wake of the financial crisis. Second point is, like what Jason was saying, I think it's a crisis which will unravel for months, if not years, and hopefully that will bring us to look differently at education and healthcare and also wage policy. And if we do a good job of looking at the access to education and health, and also at wage policy, which started a little before this crisis, then we may, if I want to end up on an optimistic note, that may actually make countries turn a little around, invest more into education and health, and look better at wage policy, so that the inequalities which had been fueling a lot of the populism in the wake of the crisis start being reduced in a sustainable way, i.e. not only through the redistribution, but really because everybody gets better chance to succeed in life.
Rob, over to you.
Yeah, I thought we had opened this up for questions. I've got a bunch of them on the screen here through this platform that we're using. Let me just throw one out there. It's sort of a good headline one. If the lockdown lasts for longer than a month or two, is it possible for the global economy to fall into a depression again? Jason.
I think anything's possible. I think the depression, though, did represent a massive policy failure in addition to all of the events. And it's just hard to see fiscal and monetary policy, allowing that to happen. So, a prolonged period of 15% unemployment in the United States and 25% unemployment in Spain. Yes, a 5-year period of 25% unemployment like we saw in the Great Depression. I really think no matter how long the lockdown is, we should have the tools to be able to stop something like that.
Kevin,
but that doesn't mean there wasn't something quite bad that could happen.
All right, Laurence, go.
Yeah, I think it's unlikely that it gets like that for many, many months. Also, I mean, all the caveats, right? Being humble because we know little, but from where I sit, this lockdown may last, a couple of months, but then that's the time. Initially, we wanted, policymakers wanted to put that in place to gain time to build up their healthcare capacity. So masks, ICU beds, things like that. We're going to get there, right? We're going to get there, and very gradually people will start going out. It won't be the same for months. We won't travel. We won't probably go to restaurants, but it will not be as bad as what it is today. And I think it will be hopefully more manageable. The risk is that we get a second wave of the virus in the autumn, in which case it seems to me that we will have to finance the same type of support to firms and people. But we will be better prepared. There will be better ICU beds. And so I think for all we said, even if the virus stays with us for a while without vaccines, without cure, the medicine that we're taking on now is extraordinary and is unlikely to be put in place to the same extent in the future. So we should, all that to say, we should be able to afford to put again in place these support policies if we get a second outbreak, because it will have likely a smaller impact.
Kevin, you teach at the institution named after the president who at the time had to deal with the depression, and are you concerned that we will deal with that in some way, or do you have the same sort of confidence that Jason and Laurence do, that we have the tools and the knowledge, as it were, to avoid such a thing?
So making policy is about making choices. If we make the wrong choices in the US and around the world, we can end up with exceptionally bad outcomes. we make the right choices, then my judgment is the U.S. economy remains resilient, dynamic, and can respond to this shock. So there's nothing inevitable about that kind of outcome. I would also say that we're even wrestling with this question of recession versus depression should make us think back how quaint the discussion was over the last several months and several years about whether inflation was treacherously too low, coming in at 1.7% instead of some vaunted target of 2.0%. Whether a month ago we said the economy is in great shape and everything in the financial markets are just swell. Again, it strikes me as though we needed humility then, we need humility now. And had we dedicated our attention to asking these hard questions about tail risks, that would be right. So as a first approximation, Rob, Gina, and the team, if the conduct of public policy, especially at central banks, was focused on the left side of the decimal point, then we might be better positioned to handle shocks. Instead, it seems to me over the last many number of years, we've been focused the right side of the decimal point, and we've been foregoing our humility with a little bit of judgment that somehow the Great Moderation was back. The Great Moderation left us with very bad alternatives in 2008, and I worry that we've treated the decade since as if we didn't internalize the lessons of a decade ago. So I end up in the camp, I think, where my fellow panelists are, which is quite skeptical of some V-shaped recovery. And the ultimate contour, whether it's a W or something else, depends largely on the conduct of policy, because the underlying foundations, at least of the US economy, remain strong. But if we let the wolf in the door, then those foundations themselves can weaken. But I think cooler heads will prevail. The strength of the economy will be because of them, not because of the likes of public officials like us. And we'll come out of this better, stronger, and faster. But we've got to make the right decisions over the next several months and several years in order for that to become true.
I'm going to ask one last question, and then we're going to close it here. This is so also from the crowdsourced. What are the problems we are storing up as a result of what's being done to fight the crisis as best as policymakers can? Is it inflation? Is it something else? What do we have to worry about? We sort of hit this already a bit, but if you had a lightning round, what would it be? I'll start with you, Laurence.
A tricky question. So the thing we've left out, right? I mean, I think we haven't talked enough about it, and Jason reminded me of that. We haven't talked enough about how interconnected to the Southern Hemisphere and the rest of the world we are. We've been very focused on the US and advanced OECD countries, but really what worries me the most actually is that this pandemic doesn't get addressed properly by emerging markets in big countries like India or other Latin America countries or Africa. It worries me a lot for themselves. It worries me a lot because it will mean that also the world will only half operate, and it will change very profoundly the way that we do business. It will cut value chain as well. It will be also harmful for emerging market economies and developing economies who really rely on globalization and their link with the developed world to actually catch up. So I think that's the main thing to me that we should be focusing on a lot more.
Jason?
I think now is not a time to be overly worried about what comes after. I wouldn't worry too much about debt. Inflation, the markets aren't expecting it. I think it's certainly possible. The idea of inflation in 2010 was ludicrous when some people were warning about that. Now it's a real possibility. And if it happens, I'll be thrilled because it would indicate we got a lot of demand. It would help lower real interest rates. It would help lower real wages. All of that would help the growth of the economy and its recovery ultimately. So I just think policy needs to do what it needs to do in the short run. And there definitely will be some messes we're going to need to clean up later. But we're
facing an existential crisis.
Right now.
We are. Jason, sorry, Kevin, you want to close it off?
Sure. Listen, I think Jason said this part right, which is we're in the middle of this war. We need to fight for a clear victory on all fronts. There was time to be sort of thinking about these risks. That time is gone. We need to address the emergency, and when the emergency is over, we need to call it. I think Jason's got a lot of really good scholarship behind his points, but I would say I wouldn't be so comforted if we found ourselves in 12 months with higher inflation. If in fact what we've done is we've created two economies, one where those that are working are seeing a huge escalation in wages to keep them working, and those that are on the sidelines aren't being brought back into the labor force. I think there's reasons to believe that higher inflation would not be an unavoidably good thing 12 months from now.
Well, good. On that note, I want to thank all of you, Laurence in Paris, Jason in the great state of Connecticut, Kevin in Florida, and Gina in the Golden State. And I'm signing off from Zurich, Switzerland. This was an illuminating conversation. I think we hit a lot of interesting things. I agree. The next one of these is going to have to, we're going to have to think about India and Africa, Latin America, and the other parts of the world as well. Or that will be maybe that we just found our next subject for one of these virtual newsmakers. So, and to everyone who watched this, thank you very much. And with that, I say Avita Sen.
Thank you.
Bye.
Au revoir.